Let's do Altria Group. Ticker symbol is MO. Let's get after it. What is the market cap? Sweet baby cheeks, Paul.
$80 billion, give or take. 17.7 PE,
Wow.
check mark. Massive profit margin.
Good Lord.
It's over 10%. That's a check there. Last quarter was 38%. Dividend, 8%.
Wow.
Okay, I'm going to do this right this time.
Please do.
$6.4 billion dividend.
Like talking.
2 checks, $6.4 billion we need to cover in free cash flow to cover that monster dividend. That's almost as much as Philip Morris itself.
Yeah, that's right.
Huge dividend.
Revenue growth is pillar number 3 for Altria Group.
Revenue growth, 25.65 to 26.15. Very, very little. Oh, by the way, Altria already has its financials for 2020 up. Philip Morris did not yet.
So this is an X? Oh, no, it's up.
Yeah, this is very, very low growth. I mean, it's basically the same. It's a $500 million more in freaking 5 years. That's not very good. But again, people don't like cigarettes.
Okay, pillar number 4 is profit growth.
All right, profit, 14.2, Jesus Christ, to 4.5.
Uh-oh.
Yikes.
Profit's down huge. I don't know what's going on there. But I will say this. This looked like a...
Yeah.
Well, but Mo went 14.2, 10.2, 7, lost 1.3, 4.5.
Yeah.
All right, this is where I'm going to look at free cash flow especially.
Okay, before you get there, you want to do shares outstanding? Stay on point here. So profit growth is down. Oh, no. And shares outstanding, we want this number going down as well.
Check mark. It is going down 1.95 to 1.85, about 100 million shares less of 5% of its outstanding shares.
Okay, current assets over current liabilities is pillar number 6, baby cakes.
7.1 billion versus 9 billion. X there.
Oh, boy, oh, boy.
I'm actually liking Philip Morris more than Altria right now.
too.
Now let's see their free cash flow number.
Okay, X for current assets. Free cash flow growth is pillar number
Look at,
7.
like no capital expenditures here. Incredible. 3.6 billion, 8.1 billion. Check mark there. 4.7,
Oh, Lord, I got to do my calculator, Paul.
8.1, 7.6. So 8.4, 16.5, and 15.7 is 32.2. I think divided by 5 equals 6.4. Nope, that's wrong. Yeah, 6.4.
Yeah, it's 6.44.
But,
You're correct.
But it's increasing quite nicely.
Karchik's saying they had a big write-down recently. I don't know what that is.
And by the way, that's what when you have a was that Jewel? That was the Jewel write-down they had. That was on their net income, not the free cash flow. You got to remember that. That's why when we were looking at the net income, I said I'm going to go to the free cash flow number. The net income was dropping and dropping and dropping, and look at the free cash flow number. It's growing and growing and growing. So, this is currently selling for 12 times free cash flow.
So give me a second. The 8.1, their dividend is 6.4 billion.
Yeah.
So they have that covered.
They had that covered, not by a ton, but they had that covered.
Average free cash flow is 6.4 billion.
So they're currently selling for around 12 times free cash flow. Does that sound about right? 12 or 13. So it's a check mark there. You got to decide for yourself with no growth whatsoever, monster dividend. Are they gonna stay stable? Are they not gonna stay stable? I don't know. But it seems like it's a pretty interesting play here. It is a lower multiple, I think. I definitely know that than Philip Morris. So I don't know. It might be better for. I think these both look pretty decent. The free cash flow number is huge.
Well, you got to like that 8% dividend too,
Capital
Paul.
expenditures are so low.
The capital expenditures here are lower than Philip Morris.
Yeah, it's incredible.
As a percentage of free cash flow. As a percentage of cash from operations.
Yeah.
Other people are saying they do indeed prefer Philip Morris over Altria. Altria has a habit of overpaying for acquisitions and a ton of goodwill. Research Jewel, I see.
Jewel is prime
Joel
example.
Greenblatt thinks that this is undervalued. Interesting.
Wait a second, has he said that, or is it part of his?
Or is it part of this?
Is it part of his magic formula?
I don't think it is.
I think you own this.
I think you do too, Mo. So.
Yeah.
Oh, okay, maybe I do. Fishy
Yeah.
face expand. Mo, what do you have?
All right. So I've made a video on what's called the 50% rule. You take your high, your previous high and previous low on the chart, zooming out a year and a half, and kind of right in that middle range is the halfway point. And this is where you can see that this stock since about March of last year, 2020, has had a very difficult time breaking through that resistance point, and it's kind of getting up there again. So this is where we come back to that overhang. This is just a lot of resistance pushing down on you, on your stock. So the odds of this stock price coming up through here and making some new highs over the last year is not in your favor. What it's going to take is a lot of volume, and again, it goes back to the same thing as the last stock. We need something, some kind of event, some kind of new product that's really going to drive volume and push this thing up and continue to go. So that's Altria Group right now. If I'm looking at this, I'm actually thinking that Philip Morris is better from a technical standpoint, just because of this overhang and this 50% rule. It's going to be very difficult for this stock to break through and go towards $60 a share.
The hard part is, guys, like literally cigarettes are a dying business. But as I've told you before, remember, whenever we want to tax anybody, what's the first thing they tax? Besides rich people.
Tobacco and
Tobacco and all these
Yeah,
things. Because they sit there and say, hey, listen, if you want to smoke, you're going to smoke anyhow. You have to get a really, really good discount on this company. Get a good dividend, and hopefully they're using the rest of their cash to buy back shares. That's how you're going to make money on these stocks, because I don't see the growth potential for these companies.